This is not financial advice, educational content only. The yield curve gets one sentence in most market recaps: the curve inverted or the spread widened. What that shorthand misses is that Wall Street actually tracks three distinct versions of the yield curve, and they measure different things. The 10-year minus 2-year spread is the one Bloomberg defaults to. The 10-year minus 3-month spread is the one with the stronger empirical record as a recession predictor, and the forward 1-year 3-month rate is what the market is pricing for the near term, stripped of current rate level effects. Today we're going to look at all three, what each one measures, what the academic record says, and why their divergences matter more than any single reading. Headlines focus on the curve. The thing actually worth understanding is one layer down. The yield curve is the line you trace when you plot U.S. Treasury yields from shortest maturity to longest. On a normal day, a 3-month bill might yield less than a 2-year note, which might yield less than a 10-year bond, sloping upward. That's the normal configuration. Investors demand more yield to hold longer, dated instruments. When that relationship reverses, when shorter maturities yield more than longer ones, the curve inverts. But the yield curve isn't a single number. Different spreads capture different parts of the curve, and each part responds to different forces: monetary policy expectations, growth outlook, inflation pricing, and the term premium, the extra yield investors demand for duration risk. Which spread you look at determines what you're actually measuring, and those three spreads don't always agree. The 10-year minus 2-year Treasury spread, shorthand 10s-2s, is the spread that appears by default on Bloomberg terminals and CNBC graphics. It has become the popular shorthand for the yield curve. What it actually measures the gap between the long end of the curve and the short to medium segment. The 2-year note is heavily driven by where markets expect the Fed funds rate to sit over roughly the next 2 years. The 10-year incorporates a longer growth and inflation outlook plus the term premium. When the 2-year rises above the 10-year, it typically signals markets expect the Fed to tighten enough to dampen growth, with rates eventually coming back down over the following decade. The empirical record for 10s-2s as a recession predictor is solid but noisy. It inverted ahead of most U.S. recessions since at least the 1970s, but lead times have ranged from roughly 6 months to over 2 years. That's a wide window. It also produced brief inversions in the mid-1990s and 1998 that weren't followed by near-term recessions. What it's not a short horizon trading signal. What it is a slow-moving macro pressure indicator. That's my read. Here's where the academic literature is more specific. The spread between the 10-year Treasury yield and the 3-month Treasury bill has a stronger empirical track record as a recession predictor than the 10s-2s. The foundational work is Estrella and Hardouvelis, their 1991 paper in the Journal of Finance, and follow-up research in the mid-1990s, which found the 10y-3m spread consistently led recessions with statistically meaningful probabilities. Estrella and Hardouvelis are real economists at the Federal Reserve Bank of New York. These are real citations. Why the 3-month bill rather than the 2-year note? The 3-month bill tracks the current Fed funds rate very tightly. It's essentially today's policy rate in yield form, not a forward forecast. So the 10y-3m spread is comparing where the Fed has rates right now against the market's embedded estimate of long-run growth and inflation in the 10-year. That's a cleaner signal. The New York Fed publishes a recession probability model using the 10y-3m spread. It's on the NY Fed's public website, updated monthly. Historically, when the 10y-3m spread reaches deeply negative territory, the specific thresholds have varied by cycle, but spreads around or below roughly 100 basis points have corresponded to elevated model probabilities. In the 2020-2023 cycle, the 10y-3m inverted to around 150 to 170 basis points by some measures, levels not seen since the early 1980s tightening cycle. That's what happened. What it meant for the subsequent cycle is still unresolved. That's my read. The third spread is more technical but arguably the most information-rich. The forward 1-year, 3-month rate, sometimes written 10y-wane, is derived from the spot yield curve and tells you what the market is pricing for the 3-month rate 1 year from now. Why does this matter? Because the 10s, 2s, and the Fed 10y-3m can both be distorted by the current level of short rates. If the Fed has hiked aggressively, the 3-month bill is elevated right now, which mechanically inverts any spread against it. But the forward 10y-3m strips out the current rate level and asks a different question: does the market expect that in 1 year? The short rate will be lower than what the long end is implying. Adrian, Crump, and Moench at the New York Fed developed a framework, the ACM model, that decomposes the 10-year yield into an expected short rate component and a term premium component. Reading the forward 10y-3m alongside the ACM term premium estimate lets you separate two very different scenarios. The curve is inverted because markets expect rate cuts coming, versus the curve looks flat because the term premium has compressed. Those scenarios have different macro implications. The 2010s saw persistent flat to inverted readings, in some measures largely attributable to compressed term premia. Not recession signaling in the classical sense. That's my read. Let me be precise about what the track record actually shows and where it stops being reliable. All three spreads inverted ahead of the 2001 recession, the 2007-2009 recession, and the 2020 recession, though 2020 is a complicated case. That was a pandemic-triggered demand shock, an exogenous event, not a demand-side recession generated by over-tightening. Attributing the 2020 outcome to yield curve prediction would be overfitting. The structural worry for current cycle interpretation: we don't know whether the post-2020 environment, the possibility of a higher neutral rate, larger federal deficits increasing Treasury supply, the Fed's balance sheet at a different level, has shifted where restrictive policy actually begins. Some economists have argued the real neutral rate has risen since the 2010s, others think it's still low. That debate is genuinely unresolved in the literature. If the neutral rate is higher, then the same yield spread might correspond to less policy restriction than it did in, say, 2006. That's not settled, that's my read. The core limitation inversion to recession lead times are too variable to be a tactical signal. Treat the yield curve as one instrument in a macro panel, not a standalone indicator. Here's how I think about reading all three spreads together. If all three are inverted simultaneously, the signal is more consistent than if only one is. The 10y-3m is the hardest to argue away academically. That's the Estrella Hardouvelis framework, built on decades of data from the Fed's HE15 statistical release. If the 10s, 2s has steepened while the 10y-3m is still negative, pay attention to why. A bear steepener, where the long end sells off while the short end holds, has historically been a different signal than a bull steepener, where the short end falls as the Fed eases. Bear steepening near the end of a hiking cycle has preceded deterioration in prior cycles. Bull steepening can be healthy normalization. The term premium component from the ACM model helps disambiguate those two. And the forward 10y-3m, if it's pricing significant near-term rate cuts, you need to ask whether that's a proactive cut, Fed moving ahead of any deterioration on a clean disinflation path, or a reactive one, responding to softening labor markets. The yield curve alone cannot answer that. Credit spreads, initial claims, and ISM data are the adjacent instruments. That's my read. Here's the practical tool. When the FOMC statement drops, pull up the 10-year minus 3-month spread on FRD, free updated daily. Then check the New York Fed's recession probability model, same spread, updated monthly. In the press conference, watch whether the Fed signals higher for longer versus active normalization, and observe whether the 10y-3m responds more than the 10s, 2s. That divergence will tell you something real about how the market is reading the short end path. This isn't advice, it's a way of looking. If the framing helped you read the next FOMC cycle differently, that's the win. I'm Diane, back next briefing.